Okay. Okay. So this is the chapter 1 handout, and this follows along with it in the book, kind of a little bit what the book has. The first chapter in this book is pretty loaded, actually. If you look at the first chapter, it might be a little overwhelming, but we're only going to do down here the financial statements, which we'll talk about in a second. But so this is the chapter 1 handout, and it goes into corporations, and we'll talk briefly about these. You guys may have already covered this in the other classes, but anyway, so corporations are kind of a strange thing in that they're almost like what they call a fictitious person. How do you spell fictitious? Well, you're not here for English, so anyway. So fictitious person. So it's almost like they create a person, and they're done by the state. The state will actually do it. So a state will grant a corporation the right to be a corporation, and it is literally creating a fictitious person. It's a fictitious person in that they can basically do everything that you and I can do except for vote. They can sue people. They can be sued. They can, they have basically most of the rights that a regular citizen has, except that they don't vote. So it's a separate legal entity. And the thing about that is then it has limited liability, because if you own stock in a corporation, that corporation is the person. So if you own stock in, say, General Motors, so let's say you buy stock in General Motors, General Motors is the one that's on the hook. They're the person that's on the hook. So if they get sued, so if something happens with a car or whatever, if they get sued, you don't get sued as you own stock in the company. You don't get sued, but General Motors, they can be sued, and they can sue other people and all that kind of stuff. So the liability is limited. Now you can lose your investment, but if they lose a lawsuit, it isn't like they're going to come and take your house or whatever or anything like that. So it's a limited liability, and this is very important because this is one of those things that is the reason why business is so successful. Because if they didn't have limited liability, if General Motors could be sued and you own stock in the company and they could come and take your stuff, you probably wouldn't invest in General Motors. And General Motors needs big money to build factories and all that kind of stuff. So anyway, the limited liability is there for big growth, but they're kind of a weird thing though, because it's created by the state. It's limited liability, and it's almost like a person. Okay. There's articles of incorporation. These are basically just the rules, the company rules. May have one shareholder or millions of them. You can have a corporation with just one person. Maybe privately traded or publicly traded. Private means that no one else can buy in the stock. So if I have a restaurant, I have Eat at Joe's, and that's the name of my restaurant, I don't want anyone else buying stock. I don't have to sell my stock to the public. I can just keep it for myself, and no one else can buy it. If you want to trade it publicly, there's a bunch of big rules on that, but you can sell it to the public. And the nice thing about this one is that you can invest in things that you have invest in businesses that you have no knowledge about. And what I mean by that, I don't mean that you're, someone's ignorant, but you may not know a lot about computers, but you can invest in Microsoft. You don't have to know. You can invest in companies that you don't know anything about, what their business is. You may not know much about building cars, but you can invest in Ford or General Motors or whatever. So maybe privately traded or publicly traded. Privately traded, usually they know the business. Not always, but usually. But publicly traded ones, you don't have to know what the business is. You don't have to know how Google works to invest in Google. Owners do not always participate in management. So just because you are an owner doesn't mean that you can walk into General Motors and fire somebody or whatever. So the owners are separate from the actual running of the business. So if you buy stock, that does not give you the right. I mean, unless you have enough of it that you can control the company, but they don't have the right to participate in management, and a lot of times they don't want to. I don't want to. If you don't know anything about General Motors, why would you want to go try to manage the place? Now, this is where it comes in. Corporations may issue financial statements. If they're publicly traded, they have to. So it's issuing a financial statement. My other marker. Is the marker on that? So, the question is, okay, so I invest in whatever. I invest in Apple, the Apple company. How do I know what they're doing? That's where these financial statements come in. That's what we're going to talk about today, the financial statements. So issuing these financial statements is basically to know how well the business is doing. That's what these financial statements are for. And we're going to have these financial statements down here. So, what did I use? Oh, by the way, another thing. Another thing for remembering items is colors. In case you guys didn't know what colors look like, this is what they look like. No, but how much you guys know about this? But humans are one of the few mammals that can actually see color. Most mammals can't. Dogs generally can't see color, and because they don't need to. If maybe a dog's a bad analogy because my dog is sitting around on couches, but let's take like something like a coyote. A coyote that can't see color doesn't need to, because it's not going to actually see what it's chasing. Let's say it's chasing a bunny rabbit. It's not going to have to know what the color of the bunny rabbit, and it doesn't make any difference. That they're probably going to smell it. The bunny rabbit's going to be hiding, and you think about the bunny rabbit, it can't see color either. It doesn't need to. It has great big ears, and it can hear the coyote coming and knows to run away. So, they don't need to know. So humans are one of the few mammals, I should say, that can actually see color. Now, you don't think about, and a huge part of your brain is dedicated to seeing color. You don't look at this and say, "Oh, that's orange. Boy, that's harder to look at. That's but it does take up more of your brain power to do this. So colors actually will increase your memory. A little trick. So using highlighters and stuff, a good way to do it. Just because it makes your brain work harder, even though you don't think about. Okay, let's get back to what I should be talking about. Okay, so these are the financial statements we're going to do. So these are the ones we're going to talk about: income statement, statement of retained earnings, in the balance sheet. The statement of cash flows is it's a required financial statement, but we're not going to cover it in this chapter. It's kind of a high level. The idea of it's real simple. What cash came in, what cash went out, but it's a little bit tricky as far as creating. So it's not going to be covered in this first chapter here. So these are the three financial statements we're going to go over, and we'll do one of these today. We'll do the first one here today, and then we'll work on it tomorrow. So anyway, so this is basically kind of the layout of the corporation. So corporations, they are a fictitious person. You can invest in them, and you don't have to know how to run the business. I don't know how to make cars, but I can invest in Ford. So this is kind of the investing side of it, that, you know, this is what corporations do. This is how they kind of exist. But I may not know how to run Ford, but I still want to know how they're doing. And so that's where these financial statements come in. You know, so if I invest in Ford, I want to know, how is Ford doing? You know, are they profitable? Are they losing money? Are they making money? How, you know, that sort of thing. So that's what these are going to be about. My desk is wiggling for some reason. Okay, so let's go to page 2. And on page 2, I'm a little confused here. My little spot down here. I'm in the basement, by the way. If you we have an office upstairs, but my wife is a therapist, so she needs confidentiality, whereas I don't. So every now and then, during the semester, you'll see someone walk behind me to go get milk out of the refrigerator or something. Okay, so basic financial statements. So we're going to look at the 3 financial statements we just talked about. The income statement, and if you don't know what those are, don't worry about it. That's why we're doing the class. Statement of retained earnings, and the balance sheet. Okay. Let's see here. Let's talk about the income statement just a little bit. So let's be the first one that we do, and don't worry about this up here right now. But the income statement. The income statement is sort of like this. It's just how much money did you make? And basically, you compare money that comes in you know, it's money coming in versus money that goes out. So what comes in, what goes out? That's basically what you do. And just give you an example. Suppose that I mow a lawn for $20, and I use $3 of gas. So I mow the lawn, I got $20, and I use $3 of gas. I probably don't even have to tell you how much money you made on this, right? You just naturally know that, like, okay, well, $20 came in, $3 went out, you made $17, right? That's all the income statement is. What came in versus what went out, what's left over. And this is true for mowing a lawn. This is true for General Motors. You know, what came in versus what went out. That's the only thing that's all the income statement is. Now, the money that comes in, we call that, those are revenues. So anything that comes in is a revenue. Same thing here. Money comes in the trade. So going along the $20, this would be a revenue. In our new nomenclature. And the gas would be an expense. Anything that goes out is an expense. So this would be an expense. So the $3 for gas would be an expense. So I mow the lawn for $20, use $3 of gas, $20 of revenue, $3 of expense. And what's left over here, this would be my income. So revenue. So same thing down here. Okay, so revenues. And if we look at our data up here, we're going to go find things that are revenues. Okay, so revenue, and by the way, sales are all the same thing as revenues. They could also be called sales, same thing. Sales and revenues are the same. Okay, so I have revenues of 54,000. And now, so this is money coming in. So 54,000 came in. It's now looking for things that went out, and going out is that. So expenses. So again, we're going to look on here until we find expenses, and we have two of them. Rent expense and salary expense. Now this is money going out. Rent expense, we had to pay the rent, and salaries, we had to pay the people that were working. So that's money coming in. These two are money going out, kind of like our lawnmower thing. Okay, so rent expense. I put a negative there because that's money leaving the place. And we'll do the same thing for salaries. Oops, 19,800. So this is money. This is money coming in. These two are going out, and what's left over will be our net income. We'll use Mr. Calculator for that. Let's see here. Mr. Calculator says $24,600. So that is our net income. So money came in, money that went out, and that's what we're left over with. And obviously, this is what you want. This is the most important number here. You know, sometimes you'll hear on the news or something, they'll say, "Oh, this company made, had revenues of $200 million, whatever it is." This really isn't the most important number. You know, because you could have a revenue of $200 million, and if your expenses are $300 million, you know, it's horrible. So really, income is is the number that you want to know. The revenues, people always pick that one because it's usually the largest number on the financial statements. You know, this is a lot bigger than this, so they'll use that number. But the income is really the number that you're looking for. That's the number you're interested in. So this is the income statement. And by the way, one of the things on here, so this is the income statement. I say headings omitted. You would, the heading would just be Zephyr Corporation. It'd be what year it's for, and you know the date that it was made, and all that kind of stuff. We don't need to put that in right now, but that when it says heading omitted, if you're wondering what that heading omitted means, it just we didn't put the company name and all that kind of stuff on it just to save room. When we're learning the financial statement, that's not. It's more of a clerical thing than anything else. Okay, so that's the income statement. And let's go to the second page. And we'll have the statement of retained earnings. And the statement of retained earnings is this. It's like a piggy bank. So, yeah, here's a piggy bank. And so this is, when retained earnings is. And retained earnings, if you think about what it says, retained just means that you kept, and then some of the earnings. And earnings are the same thing as income. So basically, your piggy bank with, forgot the ears. All right, so basically, it's sort of like this. Your piggy bank, income goes into the piggy bank. So when we make money, it goes into the piggy bank. And if we don't spend the money, it still stays in the piggy bank. If we don't pay out any of the money in the piggy bank, it stays in there. Now, sometimes they take out money and give it to the owners, and that's taking money out of the piggy bank. So this is the owner's piggy bank. Put that up here as the owners. Possibly could be after it too. And so it gets paid out. Now, when they take money out of a business, they're called dividends. Oops. Okay, so income comes in, goes into the piggy bank, gets added. When the owners take money out, it comes out of the piggy bank. Now, if the piggy bank doesn't have anything in it, if there's nothing in the piggy bank, you can't take anything out. Right? So only if there's retained earnings can you have dividends. Because if this piggy bank, the retained earnings is empty, you can't take anything out of it. So income goes in, and then dividends comes out of that. Let's see how that works over here. Okay, so retained earnings statement. Well, let's take a look at our first page here. And there's one thing on here that would obviously be on the retained earnings statement, and that is retained earnings. So this will be the retained earnings, and these are actually what they call the beginning retained earnings. Over here. So our retained earnings has 30,000. So that's what we're going to start out with in our statement here. Okay, so this. The beginning retained earnings was 30,000. So that's what we started out with in our piggy bank. Okay, so piggy bank has 30,000 in it. I guess I don't really need to keep putting this back. But, it took all the time to do such a detailed drawing. I hate to. All right. Now, so beginning retained earnings of 30,000. The income that we made. So this income down here will go into retained earnings. So we're going to send that into retained earnings. So this is the income we made, and they're going to put that into retained earnings. So net income and that's from the income statement. They made 24,600. So that'll be added into our piggy bank. Okay, you guys, I'll put the piggy bank up. So the piggy bank started out with 30,000. We just added 24,600. Now the owners, however, took out some money. So these dividends are the owners taking out money. Ooh, that's a little dark. Well, you can still kind of see it, I guess. So this is the owners. Could be one here. Taking money out of the business. So the owners take money out is through dividends. All right. So these dividends $2,400, and so that's money going out. Okay, back to piggy. Money going out is a minus 2,400. So this is what would be whatever that comes out to. That'd be what's left over in the piggy bank. 30,000, you added 24,600, you took out 2,400. Whatever's left over, this will be left over in the owner's piggy bank. That's what all we're doing here. How much do the owners have still left in that piggy bank? Mr. Calculator. 52,200. So this will be our ending. So our ending retained earnings is what's left in that. Everything's purple. This is our. Ooh, that's that's kind of dark. Oh, it looks like I crossed it out. That's a. All right. Back to pink. So this is our. Oh, look how pretty that is. Look at that. That's great. So this is what the would be left to be 52,200. I'm sorry I made a mess out of that. I didn't realize that highlighter was so dark. Okay, so just to recap before we go to the last one, this is how much money they made in whatever the period is. So if this was for the year or month or whatever, this is what they made. How much, how profitable were they? That money goes into their piggy bank. They took some money out of the piggy bank, and so this is what was left over. So there's still 52,200 left in the business that the owners have left in there. And again, they can, how much in dividends could they get paid out? Well, 52,200. That's all that's in the piggy bank. Oh. Our expenses only yearly, quarterly, or the existing time of business. Oh, excellent question. I'm sorry, I should pay more attention. This goes back to expenses, and I apologize. I put that up there a long time ago, and I was too busy. That's an excellent question. Expenses, yeah, as time goes on, expenses are recorded every day, basically, throughout. So the normal, if you go through a year, so January, February, March, April, whatever. As you go on through the year, your expenses will keep going up in total. At the beginning of the year, your expenses start out at 0. And so do your revenues. So at the beginning of the year, so January, whatever, the first day of business before you do anything, your revenues and your expenses are 0. As time goes on, the first month you pay your workers' salaries, you pay your rent and all that kind of stuff. As year goes on, these keep going up and up and up. So, what's more, 1 month's worth of rent or 2 months worth? Well, 2 months. So as time goes on, so until you get to the end of the year, and that's usually the cutoff for it. Now, someone answered quarterly. That is generally publicly traded companies do put out quarterly financial statements. If it's not publicly traded, you don't have to. So it'll be a quarter 1, quarter 2, quarter 3, and then quarter 4 is year end usually. And so this is how well they did. So if you want to have a comment, how profitable were they during the year? This is what you'd look at. And there might be significant differences between the quarters. For instance, there are stores that make basically all their money here, because of the holiday sales. So if looking at quarter 1, quarter 2, quarter 3, it might look pretty dismal. They may be losing money here and then make a huge profit in the fourth quarter. So, but anyway, they do. If they're publicly traded, they put out quarterly financial statements. But they start out every year. You start out at 0, and then you go up, and whatever they come out to at the end, you end up with this. So on day 1, it's 0. Now you get to the end of the year. So let's say let's put a year here. This is 2020. We just finished this up. When you go to 2021, you start out back at 0. And as you go through, the revenues and expenses will go up until you get to the fan. So when we talk about financial statements, usually they're talking about yearly. It could be quarterly though. You can put out quarterly how much revenue and expenses do you have for quarter 1, quarter 2, quarter 3, and all that kind of stuff. So, but every year you start out at 0. They go up until the end of the year. At the end of the year, there's a cutoff, and then it's whatever you had for your revenues after that. So this might whatever it comes out to at the end of the year. I'm just making the numbers up, but it could be whatever it is. Nope, not 0. It's 2,000. So beginning year is 0, and then as time goes on, then it'll more and more as you want. So what would the days show up for tax purposes? Companies can have different year ends, and for tax purposes, they can have different year ends. And sometimes they have a tax year that is, it doesn't have often, but you can have tax years that are different than the fiscal year. Many companies use the January 1st through December 31st. Probably, I say most of them. A lot of your bigger companies, they may use different times. Companies generally, in real life, they generally have their year ends when they look the best. Yeah, so for instance, I worked at a company called Navistar. Navistar makes trucks, but they used to make tractors. And so their year end was October 31st was their year end. Why? Because they sold a bunch of tractors during the summer, and then all the cash came in for people paying for the tractors. So on October 31st, they looked great. They had tons of cash, and so that's when they put their financial statements. A lot of your retail stores, Target, Walmart, and many of them will have a January 31st year end. Why? They make all the sales through, the holidays, and then in January they start collecting all the cash, so they have this big amount of cash, and they look the best on January 30th, 31st, and that's why they usually do it that way. It's just something that companies do. They usually have it set up that way. So, but they can have different year ends. So if this was in January 1st, it could be February 1st through January 31st. But they're always going to be for a year. There's some quirks to it because we have leap year and stuff like that you may have companies that do by weeks. So they'll have a 52-week period and a 53-week period for the odd years and stuff. But anyway, for the most part, January 1st through December 31st is what most people have. But a fiscal year can be different than a calendar year. It can be shifted. Well, I'll tell you another thing. For instance, most cities and states, they have a July 1st through June 30th year. So that's usually that their year usually goes through, from the middle of the year to the middle of the next year. And why do they do that? Why do they have it on July 1st? Because usually there's elections here, and they have to get a budget ready. They usually have a required budget, and so that budget has to be done by July 1st, and then they start the new year. So anyway, but yeah, good question. So they keep adding up for most companies, it's gonna be for a 1 year time period. Possible it's for 53 weeks or something like that, but for the most part, it's gonna be for 1 year. Okay. Well, last but not least is the balance sheet. And on the balance sheet, we have assets, and these are for anything of value. Interestingly, though, the balance sheet is for a point in time. It's not for over a period of time. This is over a period of time for the year. Say this is what the revenues were, this is what their expenses were for a year. Whereas the balance sheet is for a specific point in time. What do they have? Okay, so a specific point in time. Let's take a look here. All right, so let's put things that have value. So things that have a value. Well, cash has a value. cash. And equipment has a value. Accounts payable, this is when you owe someone else. So that is not an asset. This is when it's money that's owed to somebody else, and we'll talk about that. It's gonna be a liability, but we'll talk about this in a second. So let's the two assets we have are cash and equipment. And use right, I don't need it. Okay, so cash and equipment are the two assets we have. Oops. All right, so we have 12, 40, what is that, 60,000? By the way, just so you guys know, it's sometimes a good idea to check my answers, because sometimes it's not right. Every now and then I get students say, "Well, where'd you get that? Where'd you get that 70,000?" Well, it was a mistake. I guess stupid. Okay. All right. So let's look at liabilities. Now, this is when you owe somebody money. So let's say you buy some merchandise or something, and $3,000 worth. They send you a bill, but you haven't paid it yet. So this is unpaid. So accounts payable means you're going to have to pay it, and we call that a liability. So this is money that is owed to other people. Or businesses. And so we'll have accounts payable here. Probably put in total. You can put total liabilities in here if you want. If you only have one, it probably isn't necessary. If you had a whole bunch of them, you may want to add those all up. But it's the same, It's just adding down. Okay. Equity section. Well, there's only one account left, and that's common stock. So this common stock, the equity section, this is what the owners section. Sometimes it's called shareholders equity or share owners equity, or but it's equity section. So this is what the owners have. So the owners paid the company $4,800 for stock. So this is what they paid into the company, and this could have been done 20 years ago or something. But so the owners paid in $4,800. Now the owners still have though they're piggyback. So this, all the way down. And so we have our ending, abbreviate this, retained earnings. $52,200. And so we have total equity of whatever those two are. 4,800 plus. All right, so it's 57,000. And we're going to add these two together, and I'll tell you why in a second. So that's a 7. This is 57,000. Oh, okay, so this is the total liabilities. These are the total equity. So add those together, and they go out to 60,000. And this is why it's called the balance sheet, because those two balance. And I'll explain why in a second. So this is the total liabilities, total equity, and those equal this down here. And these two sides equal. You say, well, okay, well, that's, it's Q, but what does it mean? Well, here's what it is. You have $60,000 worth of value. It has to come from somewhere. This 60,000 has to come from. You don't get 60,000 worth of assets, out of thin air. So the question is, well, where did these come from? Where did you get all these assets from? Okay, well, borrowed 3,000. You owe 3,000, or the company owes 3,000, and the owners kicked in the other 57,000. So these two explain where that came from. How did you get that 60,000 worth of stuff? Has to come from somewhere. So the balance sheet really tells you where those assets came from. Borrowed 3,000, owners kicked in 57,000. That's how they got that 60,000 worth of stuff. And this is for a point in time. This is for, say, for example, December 31st. And for instance, in your cash, this changes daily. You pay a bill, you get, someone goes in and buys something, so this changes daily. So it's at a point in time. It says, okay, on this date, this is what we have for cash, this is what we have for equipment, this is what we owe, so forth. So it's not for the entire year, it would be only for the balance sheet stuff would be over here. Would be for the end of the year only. You don't know what the cash was at the beginning of the year, but you do know on 12/31 cash was 12,000. Any question then? Again, I didn't mean to cross that out. That's an unfortunate choice of markers, of highlighters. Okay, we're going to stop there. And don't worry about doing the right. There is no homework. We're going to go through the rest of these two together. So don't worry about I have to do this or that. So and hold on to the handout. Now, after next class, and we'll do this next class, obviously, I'll show you, where to submit it and that sort of thing. But anyway, so this is our first financial statement. And if this seems strange to you, it should. This is the first time you've probably seen these, or at least the first time you've had to create them. You may have seen them that someone else had made, but this is, the first time you've already done. So if this seems, awkward, it should. Just because of, it's new. So income statement tells you how much money you made. Statement of retained earnings tells the owners how much money they have in the business, how much is in their piggy bank. And then down here, the balance sheet says, okay, you have all these assets, all these, where did they come from? You have 60,000 worth of these assets. They had to come from somewhere. So this side explains where they came from. Borrowed, and the owners picked it. Okay. All right. So looking for a blank sheet. Okay. So next class. On Thursday, we'll finish chapter 1 handout. I think I'm going to take a little extra time on this first chapter. And the reason being, if you don't get, especially these first few chapters we're going to do, if you don't get those down, the rest of them don't make sense. So we're going to probably spend a little more time on the first few chapters, and then later on things will go faster. Just because if you get a good base in the first few chapters, the rest of it much easier. So to finish chapter 1 handout, I'll probably do some textbook problems. We're not going to have the practice exam. We'll postpone that till next week. No homework. Again, we'll finish the handout. We're meeting for 2.5 hours a week. It's quite a bit of time. We'll do quite a bit in that time. We'll try to do most of the handout online, but if we can't, there may be something you do by yourself. But no homework for next class. And hold on to this handout because this is going to get turned in. Yeah, absolutely. If you want to. No problem. Okay. Any questions? Okay. Well, if you don't have any questions, we'll call it a class. And again, no homework. Hold on to the handout, though. We're going to turn everything in next time. Okay, guys. Oh, I know. I'll put up the doggy. There we go. The hello doggy.